Welcome. Aware. Anda. Dumalang.
Huh.
Molo. Sobona. Hukandat. And a warm welcome to the Induvo Knowledgecast, the podcast where your curiosity meets insightful conversations. Today, we're going to be tackling IAS 8.
Oh, yeah.
Accounting policies, changes in accounting estimates, and errors.
Hmm.
So this deep dive should equip you with the knowledge you need to navigate the financial world, like a true savvy South African.
Absolutely. Understanding IAS 8, it's really important for anyone who deals with financial statements.
Okay.
So whether you're an investor trying to figure out, how a company's doing, or just someone who wants to make sure their stokvel is running smoothly.
Okay, so we've got a pile of resources here.
Mm.
The actual IAS 8 document, FAQs, and even some plain language summaries. Because let's be honest, even for us accounting geeks, this stuff can be a bit dense.
Yeah, and that's exactly why we're here to break it down into bite-sized chunks.
Okay, so let's start with the basics. What exactly is IAS 8, and why should we even care?
Okay, so IAS 8, it's part of a set of international accounting standards. Think of them as the rules of the game for how companies report their finances. It makes sure there's consistency and transparency. So you're not comparing apples and oranges. When you're looking at different companies or even the same company over different years.
Right, consistency is key. It's like judging a braai competition. You wouldn't change the scoring system every year, would you?
Exactly.
You need that consistency to see who's really improving.
Yeah. IAS 8 makes sure everyone is playing by the same rules, making it easier to compare financial performance and spot any dodgy dealings, Someone trying to slip a Wurzen from last year's competition.
Okay, so IAS 8 is all about keeping things consistent and transparent. But the business world is constantly changing. So how does IAS 8 keep up?
So IAS 8 has been around since 1993. And just like a good bottle of Pinotage, it's matured over time.
Oh, yeah.
It's been revised and updated to reflect the evolving needs of the global business landscape.
So it's not just some dusty old rule book tucked away in a corner.
No, not at all. It's a living document that's constantly adapting to ensure financial reporting remains relevant, reliable, and comparable.
Okay, so now that we have a sense of what IAS 8 is, let's dive into the nitty-gritty, starting with accounting policies, the building blocks of financial reporting. Can you break down what those are in plain English, please?
Sure. Think of accounting policies as a company's recipe book for their financial statements. They outline the specific methods and procedures a company uses to record and report its financial transactions. So everything from how they depreciate their assets to how they recognize revenue is guided by their chosen accounting policies.
So it's not just about throwing numbers on a page. There's a method to the madness.
Absolutely. IAS 8 provides a clear hierarchy of guidance for selecting these accounting policies. So first and foremost, companies need to follow IFRS, the International Financial Reporting Standards. Think of this as the master chef's instructions, the ultimate authority.
Got it. IFRS is the boss. What happens if there's no specific IFRS rule for a particular situation?
Then it comes down to professional judgment. Accountants need to exercise their best judgment, considering the conceptual framework, which is like a set of guiding principles for financial reporting. Think of it as the philosophy behind the cooking.
The conceptual framework.
Mm-hmm.
That's the framework that ensures financial reporting is relevant, reliable, and comparable, right?
Exactly. And if there's still no clear answer, accountants can look to other sources for guidance, as long as they don't contradict IFRS or the conceptual framework.
Okay, so companies have their accounting policies all set. But what happens when they need to change something? Can they just switch things up whenever they like?
Not quite. IAS 8 outlines specific conditions when a change in accounting policy is allowed. There are two main scenarios. First, if a new IFRS comes into play. Companies are obligated to adapt their accounting policies accordingly. Think of it like a new regulation saying all borrowers must be cooked on a gas spray. Everyone has to follow suit.
That's a big change. What's the other reason they might change a policy?
The second scenario is when a company believes that changing an accounting policy would result in more relevant and reliable information being presented in their financial statements. So it's like switching to a high-tech braai thermometer. You're not changing the fundamentals of braai, but you are improving the precision and reliability of your results.
Makes sense. But what about all those past financial statements? Do they just get forgotten when a company changes its accounting policy?
That's where things get interesting. IAS 8 requires something called retrospective application. When a company changes its accounting policy, this means they need to adjust past financial statements, as if the new policy had always been in place.
So they're basically going back in time and rewriting their financial history.
In a way, yes, they need to go back and recalculate everything, which can be quite a task. Imagine having to go back and track every single piece of boards you've ever bride and adjust the cooking time based on a new recipe. It's a big job.
I can see how that could get messy. But surely there are limits to how far back companies can realistically go.
You're absolutely right. There are limitations to retrospective application. Sometimes it's simply impossible to obtain all the necessary data to accurately adjust past financial statements. Imagine trying to reconstruct a braai from 5 years ago.
Yeah.
Who can remember exactly how much charcoal they use or how long they cooked each steak?
Yeah, exactly. Sometimes the mists of time obscured those finer details.
And that's where the concept of impracticability comes in. IAS 8 recognizes that in some cases. It's simply not feasible to retrospectively apply a new accounting policy or correct a past error. The data might be unavailable, or the cost of obtaining it might be prohibitive.
So it's not about being lazy, it's about being realistic.
Exactly. IAS 8 provides guidance on how to handle these situations fairly and transparently.
So we've covered accounting policies and how they can change. Now let's move on to a related but distinct concept: accounting estimates.
Ah, yes, accounting estimates. Those educated guesses about the future that can make even the most experienced accountant feel like they're playing dice with their financial statements.
It's like trying to predict how many Springboks jerseys will be sold during the Rugby World Cup. You can look at past trends and make an educated guess, but there's always an element of uncertainty.
A perfect analogy. Common examples of accounting estimates include things like estimating bad debts, so how much money a company might lose, from customers who don't pay their bills, or depreciating assets like delivery backies, how much value they lose over time.
So these estimates involve a lot of assumptions and predictions about the future.
Exactly. And just like with any prediction, there's always a chance those estimates could turn out to be wrong. But IAS 8 provides guidance on how to make those estimates as accurate and reliable as possible based on the information available at the time.
Okay, but how are these estimate changes different from those policy changes we discussed earlier? They both seem to involve adjustments to financial statements.
That's a great question. The key difference lies in how they are applied. Remember how we talked about retrospective application for changes in accounting policies? Well, changes in accounting estimates are applied prospectively.
Prospectively, meaning going forward.
Exactly. So if a company changes an estimate, they only adjust the current and future periods, not the past. It's like realizing halfway through the Rugby World Cup that you overestimated Springboks jersey sales. You adjust your forecast going forward. But you don't go back and change the sales figures from previous matches.
Got it. So no rewriting history for estimate changes.
Precisely. It's about acknowledging that our understanding of the future can evolve, and we need to adjust our financial reporting accordingly.
Okay, so we've tackled accounting policies and accounting estimates. Now for the final piece of the IAS 8 puzzle: errors.
Ah, yes, errors. Those unwelcome guests at the financial reporting party. And we're not talking about minor typos or rounding discrepancies here. We're talking about genuine mistakes in those past financial statements that need to be corrected.
Like accidentally putting sugar instead of salt in your braai marinade. That's a big mistake.
Exactly. Errors can arise from all sorts of things. Mathematical mistakes, applying the wrong accounting policy, overlooking crucial information, even plain old fraud. Whatever the cause, if a company discovers a material error in its past financial statements, they have a responsibility to correct it.
Material error. Does that mean only big errors matter?
Good question. Materiality is a key concept in accounting. It essentially means that an error is significant enough to influence the decisions of someone looking at those financial statements. A tiny rounding error probably wouldn't qualify, but forgetting to record a major expense certainly would.
Right, so it's about whether the error would actually make a difference to someone's understanding of the company's financial position.
Exactly. And when it comes to correcting material errors, IAS 8 prescribes a method called retrospective restatement. This means going back and fixing the financial statements for the period. The error occurred as if the error had never happened.
So it's like going back to that braai where you accidentally use sugar instead of salt.
Yeah.
And trying to reconstruct the whole meal.
Well, not quite that drastic, but you've got the right idea. Retrospective restatement is about presenting a true and fair view of the company's financial performance, even if it means admitting to past mistakes.
That makes sense. But we talked earlier about how retrospective application can sometimes be impracticable.
Hmm.
Does the same apply to error corrections?
Absolutely. There are situations where retrospective restatement of an error might be impossible or just too costly. Imagine trying to track down all the ingredients from a braai you hosted 5 years ago. It's just not feasible.
So what happens then? Do companies just get a free pass?
Not at all.
Yeah.
IAS8 provides alternative approaches for those situations. For example, a company might restate its financials from the earliest practicable period. Maybe they can go back 3 years, but not 5. Or in some cases, they might make a prospective adjustment, recognizing the effect of the error in the current and future periods without changing the past. It's like acknowledging that you forgot to include the cost of the firelighters in your budget. But rather than trying to reconstruct all your past braai expenses, you just adjust your budget going forward.
That makes sense. It's about finding a practical solution while still being transparent about the situation.
Precisely. And the key in those cases is, again, transparency. The company needs to clearly explain why retrospective restatement was impracticable and how they've addressed the error.
So even when dealing with the complexities of impracticality, IAS 8 still emphasizes clear communication and accountability.
Absolutely. IAS8 is all about providing a framework for navigating the often murky waters of accounting policies, estimates, and errors, while always prioritizing accuracy, consistency, and transparency.
And by understanding these principles, we can all become more informed consumers of financial information, whether we're seasoned investors or simply trying to make sense of our own personal finances.
Well said. So we were exploring the intricacies of IAS8 before. Those accounting policies, estimates, and the occasional error. That can crop up in a company's financial reporting.
Yeah, we talked about how IAS 8 emphasizes the importance of transparency, especially when those tricky situations arise, like when it's impossible to go back and restate everything perfectly.
Exactly. It's like trying to find a missing sesoti stick in a mountain of braai coals after everyone's gone home. Sometimes you just have to acknowledge that some things are lost to the braai gods.
Too true. But IAS 8 doesn't let companies off the hook that easily. What are some of the specific disclosure requirements companies need to follow to maintain that transparency?
Good question. IAS8 has a whole section dedicated to disclosures because simply correcting errors or changing policies isn't enough. Companies need to be open about those changes and explain them clearly to anyone looking at their financial statements.
So it's like sharing the recipe for your award-winning chakalaka. A little bit of openness goes a long way.
Exactly. When it comes to changes in accounting policies, companies need to disclose the nature of the change, their reasons for making it, and how it impacted their financial numbers. They need to lay it all out on the table, like a perfectly presented braai platter.
So no sneaking in a change from charcoal to gas without letting everyone know.
Exactly. And this level of detail is crucial for investors and other stakeholders who rely on these financial statements to make informed decisions. No one wants to invest in a company only to find out later that they've been cooking the books, so to speak.
Right. It's all about building trust and ensuring everyone's on the same page. Now, what about changes in accounting estimates? Are the disclosure requirements similar?
They are, but with a slightly different focus. For changes in estimates, companies need to explain the nature and amount of the change and how it impacted the current period's financials. They also need to discuss whether this change might have a ripple effect on future periods.
So if you've adjusted your sales forecast for Springboks jerseys based on how the team's performing, you need to be upfront about that change and what led you to make it.
Precisely. And if you can't reasonably estimate the future impact, say because the Boks are having an unpredictable tournament, you need to disclose that uncertainty as well. It's about acknowledging the limitations of those crystal balls we accountants sometimes pretend to have.
Uh-huh. No guarantees even in the world of accounting. Now, what about those errors we talked about earlier? Are the disclosures for those even stricter?
You bet. When it comes to prior period errors, IAS8 really puts companies under the spotlight. They need to clearly explain the nature of the error, how they corrected it, and the impact on each of the financial periods affected.
It's like confessing you accidentally used sugar instead of salt in your braai marinade. Honesty is the best policy, even if it's a bit embarrassing.
Exactly. And if they couldn't restate their financials fully due to impracticability, they need to provide a detailed explanation of why and how they addressed the error. It's all about taking responsibility and demonstrating a commitment to accuracy and transparency, even when they've stumbled.
So IAS 8 is like the referee in the financial reporting game, making sure everyone is playing by the rules and being upfront about their moves.
That's a great way to put it. It's the framework that ensures companies are being transparent. With investors and other stakeholders giving them the information, they need to make informed decisions.
You might be thinking this is all well and good, but I'm not an accountant, so how does this affect me personally?
That's a valid question, and it's important to remember that even if you're not analyzing financial statements every day, understanding IAS 8 can help you make smarter financial decisions, whether you're investing in the stock market or just managing your own personal budget.
It's like knowing the rules of the game whether you're a player or a spectator.
Exactly. By understanding how companies report their finances, you can better assess their performance, spot potential red flags, and make more informed choices about where you put your hard-earned money.
It's like being able to spot a dodgy piece of borewors before you take a bite.
Mm.
Now let's shift gears a bit and talk about the concept of materiality. We touched on it briefly earlier, but can you explain in more detail why it's so important in the context of IAS 8?
Of course, materiality is a cornerstone of accounting, and IAS 8 emphasizes its importance throughout the standard. Essentially, it's about determining whether something is significant enough to warrant attention. It's about distinguishing between a microblip and a major earthquake in the financial landscape.
So it's like deciding whether a slightly overcooked piece of borewors is a minor mishap or a major bride disaster.
Exactly. And while materiality is ultimately a matter of professional judgment, IAS 8 provides some guidance. It states that information is material if omitting it, or misstating it could influence the decisions of users of the financial statements.
So a few burnt edges on a borewors might not be material, but a whole batch of raw sausage would definitely raise concerns.
Precisely. And this concept of materiality plays a crucial role. When it comes to accounting policies, changes in estimates, and error corrections, if a change or error is deemed immaterial, meaning it wouldn't significantly affect the overall picture, then a company might not need to go through the whole retrospective adjustment process.
So there's some flexibility built in as long as the company isn't trying to pull a fast one.
That's right. But it's important to remember that even immaterial errors made intentionally to manipulate financial presentation are a big no-no. That's like sneaking an extra piece of borewors when no one's looking. Not cool.
Definitely not playing by the bra rules.
Yeah.
So honesty and transparency are paramount, even when dealing with seemingly minor issues.
Absolutely. Now let's bring all of this to life with some real-world examples of how IAS 8 plays out in practice.
Sounds good. I think those examples will really help solidify our understanding of this sometimes abstract topic.
One common scenario is the adoption of a new accounting standard. Remember our earlier analogy of a new rule requiring all borewors to be cooked on a gas braai?
Yes, I can still hear the collective gasp from the charcoal purists.
Well, the same thing can happen in the accounting world. When a new IFRS is issued, it might require companies to change how they account for certain transactions. And IAS 8 provides the guidance on how to implement those changes consistently and retrospectively.
So it's about ensuring a smooth transition and making sure everyone's following the new recipe, even if some people grumble about it.
Precisely. Another common example is the correction of a prior period error. Let's say a company discovers it's been understating its expenses for the past few years.
Oops. Sounds like someone forgot to add the cost of the firelighters to their braai budget.
Indeed. In this case, IAS 8 would guide the company on how to restate its financial statements. For those affected periods, they'd need to go back and adjust their expenses, which would likely impact their reported profits.
So it's about making things right, even if it means admitting you've made a mistake and potentially taking a hit to your bottom line.
Exactly. And this commitment to accuracy and transparency is crucial for maintaining the integrity of financial reporting and building trust with investors.
Now, what about those situations where retrospective restatement is simply impracticable?
Right, like trying to reconstruct a braai from 5 years ago, sometimes the information is simply lost in the mists of time, or the cost of retrieving it would be astronomical.
So what happens then? Does the company just throw up its hands and say, oh, well, too bad?
Not at all. IA8 provides alternative approaches. For example, the company might restate its financials from the earliest practicable period. Maybe they can go back 3 years, but not 5.
So it's about doing the best you can with the information you have. No need to go on a wild goose chase for a missing society stick.
Exactly. Or in some cases, the company might make a prospective adjustment, recognizing the effect of the error in the current and future periods, but not changing the past. It's like acknowledging that you forgot to include the cost of the firelighters in your budget, But rather than trying to reconstruct all your past BRE expenses, you just adjust your budget going forward.
That makes sense. It's about finding a practical solution while still being transparent about this situation.
Precisely. And the key in those cases is, again, transparency. The company needs to clearly explain why retrospective restatement was impracticable and how they've addressed the issue.
So even when dealing with the complexities of impracticality, IAS 8 still emphasizes clear communication and accountability.
Absolutely. IAS 8 is all about providing a framework for navigating the often murky waters of accounting policies, estimates, and errors, while always prioritizing accuracy, consistency, and transparency.
And by understanding these principles, we can all become more informed consumers of financial information, whether we're seasoned investors or simply trying to make sense of our own personal finances.
Well said. Now, before we wrap up our deep dive into IAS 8, I think it's worth highlighting one more crucial aspect of this standard.
Okay, back to IAS 8. What is this other crucial aspect you wanted to highlight?
It's the idea that IAS 8 isn't just a set of rigid rules. It's actually a framework for making sound judgments in a complex world. It encourages professional judgment and recognizes that accounting isn't always black and white.
Yeah, that makes sense. After all, we're dealing with estimates, predictions, and sometimes even a bit of guesswork when it comes to the future.
Exactly. IAS 8 acknowledges that flexibility is sometimes needed, especially when dealing with those gray areas where there's no clear-cut answer in the rulebook. But it also emphasizes that any judgments made need to be grounded in solid reasoning, and most importantly, disclosed transparently.
So it's about striking that balance between following the rules and using your noggin when the situation demands it.
Precisely. And that's why understanding the underlying principles of IAS 8 is so crucial. It's not just about rote memorization of rules, it's about developing that critical thinking mindset that allows you to apply those rules intelligently and ethically.
So it's like being a braai master. You know the basics, but you also need to adapt to the situation, whether it's adjusting the heat, adding a bit more wood, or even improvising a new marinade when you run out of ingredients.
I love that analogy. It perfectly captures the essence of what IAS 8 is all about. It's about having that deep understanding of the principles that allows you to navigate the complexities of financial reporting even when things get a bit smoky.
Okay, I think our listeners have a pretty good grasp of IAS 8 by now, thanks to your fantastic explanations. But before we wrap things up, I want to bring it back to our savvy South African listeners. How can understanding IAS 8 actually benefit them in their everyday lives?
That's a great point. It's easy to think of accounting standards as something only relevant to big corporations and finance professionals. But the truth is, the principles underpinning IAS 8 can benefit anyone who deals with money, which is pretty much everyone.
Right, whether you're investing in a local business, participating in a stokvel, or simply trying to make sense of your own household budget. The principles of consistency, transparency, and accountability are universally applicable.
Exactly. For example, if you're considering investing in a small business, wouldn't you want to know that they're following sound accounting practices and being transparent about their financial performance?
Of course. It's like checking the meat's temperature before you take that first bite.
Yeah.
You want to make sure things are cooked to perfection.
Perfect analogy. Understanding IAS 8 gives you that framework for asking the right questions, for digging a little deeper, and making sure you're not getting a half-cooked story.
And even on a personal level, the principles of IAS 8 can help you make more informed financial decisions, whether it's tracking your expenses, setting a budget, or planning for your retirement. Having that clarity and consistency in your financial reporting can make a world of difference.
It's about empowering yourself to take control of your financial well-being, and IAS 8 provides a valuable roadmap for doing just that.
Well said. This has been an enlightening deep dive into the world of IAS 8. And I hope our listeners are walking away with a newfound appreciation for this often overlooked but incredibly important accounting standard.
I agree, it might not be the sexiest topic, but as we've seen, understanding IAS 8 can have real-world benefits for everyone, from seasoned investors to everyday South Africans trying to manage their finances wisely.
And on that note, we've reached the end of our deep dive. But remember, the learning doesn't stop here. I encourage everyone to keep exploring the world of finance and accounting. It's a fascinating and empowering journey.
Absolutely. Knowledge is power, especially when it comes to money matters. So stay curious, keep asking those insightful questions, and never be afraid to dig a little deeper.
From all of us here at the Indubo Knowledge Cast, Totsians. And may your financial decisions always be as well seasoned as a perfectly braised steak.